Welcome to Dollars and Cents. We're gonna hopefully try and make some sense out of this past week's headlines. Boy, what a week it was. Certainly, Russia's invasion of Ukraine is on everybody's mind this morning, and how all of that plays out for the future. So we'll try and make sense of that on the program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. So we want to start off the program with just some thoughts, if you will, on those headline events that certainly shook the world this past week. And it's interesting because at the age that I am at, I'm 51, I grew up in that time where the Cold War was still with us, but was transitioning away from that. So most of my adult life, if not all of it, I suppose, has been in this sort of post-Cold World era where the focus of countries has been on the economy and economic globalization, and all countries sort of becoming wealthier, if you will, through this notion of being able to sell one's products pretty much in any place on the planet. And certainly that period of time brought a lot of stability, brought a lot of wealth, not just to the US, but across the globe. If you look at the percentage of the population is living in poverty today globally versus where it was 40 years ago, you can certainly attribute those improvements to humankind as a result of this sort of global economic approach that the world's countries have had in sort of this post-Cold War area. But I suppose 40 years of post-Cold War global economic activity has caused us to sort of forget a couple of things along the way that perhaps this past week's headlines served as a stark reminder. First and foremost, not everybody wants the same thing. I think it's very clear that Russian leadership, particularly the individual known as Vladimir Putin, wants the old Russia. I think that's pretty clear in some of the speeches that he made. And, I guess understandably, that sort of makes sense when you consider that Russia itself no longer a superpower, right? I mean, the economic, and was one of the kind of the statistics that I was sharing this past week with the clients that we were visiting with. The size of the Russian economy is equal to about half the size of the economy of the state of California. Now that should strike you as saying, well, wait a minute, that's not a very big economic power, if you will. And in the pecking order of things, if you're measuring GDP, yeah, that's not a big power. Now, they've got some stuff that the world uses and still relies on very heavily in the form of oil and natural gas. And so anytime you can have those prices increase, well, then certainly that goes directly to your economic benefit. But the reality is, when you think of it, it's almost a third world kind of country in terms of the size of the economy. And certainly, when we talk about wealth disparity, wealth discrepancy, perhaps Russia gives a little perspective. You hear a lot of that conversation about the wealth disparity in this country. And the reality is, I think a lot of those statistics don't include the amount of government payments, nor do they sort of net out the tax load of those that are higher income. But again, that's a little bit of a digression. Anyway, the reality is that if you want a classic example of wealth disparity, look no further than what is happening in Russia and what's been happening in Russia over the course of the past couple of decades. So dramatic, sort of a return, if you will. They would like a return, very clear, and he said it as much in his speech this past week, a return to the Cold War era, power, economic might, superpower, but that's gotten forgotten sort of along the way. That, again, clearly, not everybody wants the same thing, and certainly the leadership of Russia would be a perfect example of that. And we have to recognize that. We can't just assume that. And I guess that gets to the second thought that I had as things were playing out this week, and that is you have to still be afraid of the bully in the sandbox. And we talk a lot about nowadays, we think that if we just talk calmly to that bully or we treat him nicely, eventually he'll come around. If we maybe put him through some programming and again, just talk to him nicely, point out the pros and the cons, he'll come around. I think this is a stark reminder that's not how many in the world, particularly when you are in charge of a country that you want different things than what everybody else wants, then there's not a lot of reasoning that you can put to that equation. And the reality is that that's premise. If you assume that you're going to be able to talk to the bully, then perhaps that premise isn't valid in the first place. And certainly our foreign policy over the course of the past 40 odd years would suggest that. Wall Street Journal had a fascinating article in it on this weekend, in the weekend edition, that had all of these pictures of every president going back for the past 30 years, sitting down with this guy, thinking that they're going to talk it out and all those kinds of things. The reality is it doesn't work. There are real enemies out there who would seek to destroy and to do harm to this country. So better start addressing the reality and perhaps not worry quite so much about the things that we worry about here in this country. I'll let you come up with your own list of things that perhaps we're worrying about these days, that in the grand perspective of the global stage, this might give some perspective. Anyway, clearly the market had a lot to say about this past week, but in the end, what was crazy about all of that is with the 4-day market week, because of course Monday the markets were closed because of President's Day, markets were actually up. S&P 500 was up almost 1% for the year. NASDAQ was, for the week, NASDAQ was up 1%. The Dow basically flat. How on earth did the markets respond that way? Now, it certainly wasn't a smooth path. If you were watching the markets on Thursday, you saw them drop 3.4%, only to wind up with a gain of 3.5%, almost a full 7-point swing in the market on Thursday. That's only the 16th time in the past 15 years where the markets have ended positively after being down at least 2.5% earlier in the day. That's the definition of volatility. We're going to talk more about sort of how that week played out and how on earth that happened after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Talking about the week that was certainly a very strange week for the markets at the end, given the headlines involving Russia and Ukraine. The markets, in fact, wound up being positive for the week. Overall, S&P 500 slightly up, slightly less than 1%. So welcome to Dollars and Cents, where we're helping folks hopefully make some sense of the week that was, particularly after you have such dramatic headlines like Russia's invasion of Ukraine. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan. So talking particularly before the break about Thursday, particularly that big swing. At one point the markets were down 3.4% and only to wind up for the day 3.5%. So a 7 percentage point swing. Folks, that's the very definition of volatility. Remember, volatility can go both ways, both up and down, right? Volatility is movement up and down. And so sometimes I think when we think about the markets, we only think about that down part. Certainly there was an up part, particularly to what happened this past week. So how on earth did that happen? How did we go? Because Thursday was when the tanks were literally rolling in to the capital city of Ukraine, despite Putin's statements over the past weeks, months, years that, oh, I'm not going to do that. So how did that market wind up sort of staging that big of a reversal? Well, it seems that there were two things afoot, and I think they bear discussion on the program. First of all, the data suggests that a lot of that shift in market sentiment was actually caused by retail investors. So give yourselves a hand, because retail investors are those folks, normal people, who are putting money into investment. So that certainly helped to change and reverse sort of the pattern. When you look at the data on Thursday alone, investors were there to sort of prop up the markets. Total net inflow of about 1.5 billion in US listed stocks and ETFs. That was the most in a couple of weeks. In essence, the individual investors were buying on the dips, right? Market dips down. That's an opportunity to invest when things are on sale. So certainly not a bad thought if you think about the markets from where they were at the beginning of the year to where they are, where they wound up this past week. Somewhere in that 10% correction sort of territory. So, all right, maybe that helps to explain a little bit what was going on Thursday. Similarly, let's not forget, though, the economic issues that have sort of slid to the back of the paper this past week, but they are very significant. The inflation reading that came out this past week, north of 6%, and certainly the specter of higher interest rates, those still have an impact. And I think this past week there was maybe some thought that because of these headlines and how dramatic these headline events can be, that perhaps that interest rate increase that is on tap for March, coming right up in about 3 or 4 weeks, might not be a half a point. It may only be a quarter point. So maybe these events in Ukraine suggest that we'll see the Federal Reserve sort of raise rates at a little bit sort of slower pace, if you will. So that in and of itself would cause interest rates and money costs to be lower for perhaps longer. And so perhaps that was also at play in the overall market. So in essence, sort of that slower pace of interest rates may have also contributed to that. Again, though, bigger issue in terms of longer term impacts in the economy, inflation, interest rates. We think it's more important to sort of watch those more than anything else. The market has a tendency on these headline events to be relatively short-lived in terms of its reaction. We think back to 9/11, or we think back to the Iraq invasion of Kuwait. It didn't take a lot of days before the markets recovered to those pre-invasion dates. When Iraq invaded Kuwait, it was 189 days before the markets recovered to that that level that they were before that invasion. Now, obviously, this is a little different because in Kuwait we got involved, and I don't know that we're going to get involved on the ground like we did in that situation. But again, when you go back through history and see kind of these headline events, the market has a tendency to respond very quickly, but also recover very quickly. So the point there is it's not necessarily about the headline event. It's really more always about those real economic issues. And so for us, it still means inflation, interest rates. Those become the more important pieces of the equation. Regardless, anytime you run into these types of headlines, there's always some things or some truths that investors should keep in mind. And so we want to recap those three. First, and this one shouldn't really surprise you, but you can't predict the future. As much as you think you might be able to see how this all plays out, you're not going to be able to predict it with any degree of accuracy. As much as you think that, oil's going to do this, or oil's going to do that, or consumer goods sector is going to do this or that, you're not going to really be able to predict that with any degree of accuracy. So bottom line then, if you're an investor, you should be diversified. That eliminates guessing where things are going to go, because if you're diversified, then you have different things. And if you own different things in your investment portfolio, then they're going to do different things at different times and produce different results. That's the nature of diversification. So maybe you've got something in your portfolio that has gone down a lot. If we think of what's gone on so far this year, large tech growth companies have certainly gone down a lot, but meanwhile, dividend paying companies haven't. Again, the underscore of why you are diversified. Different things doing different results at different times in your portfolio. Number two, now is kind of a bad time to really make big changes to the portfolio. Why? Because chances are those changes that you're going to be making are going to be dictated by the very powerful emotion known as fear. Fear will cause you to overreact, to overcorrect. Frankly, you want to reposition things when the world is in more of a calm state. That's why all throughout last year, even though the markets were continuing to go up and up and up and up and up, we were talking at length on this program and with our clients the notion of rebalancing, taking some profit, particularly off those large tech category companies, and rebalance the portfolio when times are normal. So, in other words, review the portfolio allocation, and do that when things are calm. Rebalance on a regular basis will allow you to sort of avoid overreacting when things aren't so calm, because you certainly don't want to do that in a panic. And then lastly, consider embracing the surprise instead of fleeing from it. Well, what are we talking about there? Well, the reality is that these headline events provide an opportunity for folks, if they're maybe sitting in cash, or maybe they were heavy on the bond side, they were looking for opportunities to sort of get out of that bond, get out of that cash, or not get out of it altogether, of course, but perhaps reduce it. This certainly presents an opportunity for investors to do just that. So certainly an important opportunity to sort of look at and say, okay, if I've got money, if I've got cash, then now is a good time to maybe start some kind of a dollar cost averaging type of an approach where I'm putting money in on a regular basis. That certainly helps to smooth out volatile times like this. So those are the three takeaways for investors to be thinking about. We're going to go to a break. When we return, we'll continue the conversation here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. Last week on the program, we were joined by our fellow certified financial fiduciary and also happens to be a CPA, Kristen Cayley at Nelson Financial Planning, talking about some do's and don'ts of taxes. We also talked in that program about a conversation involving cybersecurity and making sure that folks were on top of their cybersecurity, particularly with some of the FBI warnings and the warning that we received from our regulator, FINRA, about making sure that your systems were up to snuff, if you will, because of the increased concern that there was going to be a lot of Russian cyber attacks. And so one of the things that we mentioned in that program was that we were going to be chatting a little bit about some of the scams that the folks at the FBI specifically talk about. And every year they put out sort of this list of the top 10 scams that seniors need to be aware of. But frankly, we kind of ran out of time talking about tax stuff last week. So we are going to be talking about those scams, and sort of certainly ties in well with some of the concerns that have been issued to the public in terms of being aware of cybersecurity activity. So this one probably should be number one on the list. Just beware of those types of things that happen email-wise, phone-wise. My goodness, there's so many different ways that folks, particularly seniors, are taken advantage of as a result of the technology that we have today. So anyway, in this segment, we're going to talk about sort of the three biggies, if you will, that you want to be aware of, along with sort of the remaining 7 on that top 10 list that the FBI recently put out in terms of the biggest online scams. So welcome to the program. This, of course, is Dollars and Cents. We help you make sense out of all of life's decisions involving your dollars. Central Florida's longest running radio program, coming to you on a variety of stations throughout Central Florida. If you're not able to pick us up on your radio, then you can certainly pick us up as a podcast on your favorite podcast channel of choice. If you have problems finding our channels on any of those platforms, just go to our website, nelsonfinancialplanning.com. Upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get immediately connected to our channel. And so we encourage you to subscribe so that you can get notification on a regular basis whenever we've added new material to those podcasts and YouTube channels. So my name, of course, Joel Garris. I'm with Nelson Financial Planning. So let's talk about those biggest online scams, courtesy of the FBI. The three biggies, and I guess we'd have to sort of add in the reality of a foreign country trying to do a cyber attack. That's probably one of the biggies. But how on earth do you recognize that? Just be careful. Don't click on anything that looks unfamiliar, or don't answer any calls or texts from anybody you don't know, because all of those are designed to trick you into giving up your information. And they're very good at that. These are professional criminals whose job it is to separate you from your money, your identity, and consequently create some havoc in your life. So, top 3 big scams, if you will, in terms of online scams. Number 1, confidence fraud and romance scams. Talk about playing at somebody's heartstrings, right? Particularly after a couple solid years of COVID, people have been staying at home, not engaging with their fellow man, and so consequently perhaps more vulnerable than ever before to someone offering friendship and romance. In fact, according to the FBI's annual Elder Fraud Report, these types of scams accounted for a record loss of $281 million in dollars for seniors. Real figure, of course, as we all know, is truly higher because most of that stuff doesn't get reported. They estimate only about a quarter of those online romance scams are even reported. So figure that's about $1 billion that elders, seniors lose each and every year to these confidence fraud or romance types of scams, certainly on an uptick as a result of the past couple of years of COVID. Similarly, compromised emails, right? You get an email, it says click here, confirm your information. That is the second single biggest course of scams against older Americans. it appears to be from a bank or a store or whatever the case may be, and you opt in, and then it asks for your information. Or maybe it's an email that says, hey, you need to take action now because this is going to run out, or the opportunity is going to be gone. Or maybe just take our survey, click on the link, and then just all you need to really do is just verify your date of birth and social security number, and you'll be fine. And you can take our little survey. That, folks, is a scam. Stay away from that. That, in fact, is the second biggest scam after those romance scams that happen where you're, get somebody reaching out and saying, hey, I saw your picture or your profile or whatever the case may be. Let's be friends and see where it goes. So that's number one and number two. And then, of course, number three is identity theft, which has unfortunately more than tripled over the course of the past year. This notion of getting your information and utilizing it to basically get money is on the uptick, that is for sure. And then, of course, you can't forget the tech support scams, right? Those are the ones that became also, again, some of these became even more prolific as a result of the pandemic. People trapped at home, so more romance schemes, people playing on their computers more, so no more sort of bank or store-based types of scams. And then this last one with tech support, right? I mean, we all have trouble navigating the technology that exists today. So oftentimes you'll get an email from tech support, or you'll get a pop-up, or you'll get something about renewing your cybersecurity software, things like that. Those have really proliferated during the course of the pandemic, saying that you've got a virus and you need to block it. Just click on this or download that, or call this number, those types of things. And the bottom line is that what you've got to do really to make sure that what you're utilizing is in fact secure, or should I say, one way that you can tell that a website actually is legitimate is if you go to the address bar, right, which is that stuff that's at the kind of the top, if you will, and make sure it has like a picture of basically like a lock, and then it should have the letters HTTPS after it. The S is a security, stands for a security type of thing. But remember that lock. That's how you determine whether it is in fact one of the ways in which you can determine whether it's a legitimate website or not is kind of looking for that lock as you are searching. So make sure that that is a verified website, as evidenced by that little lock that you would see up there. So that's the way in which you can kind of try and hopefully avoid this. The reality is it happens to everybody. It happened to me about a year ago. I have a fraud alert on my credit to protect myself, so that if anybody decides to do anything in my name, then there's an immediate phone call to me. That's how a fraud alert works. And so this is just something that we all have to deal with in today's world. There's a bunch of others that the FBI mentions on its scam lists. We're going to slide to the break, though. When we get back from the break, we'll just run those really quickly so you are at least aware of those online scams that the FBI is warning seniors about. So we'll do that when we return here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. Talking about the FBI's list or warning of the top 10 online scams for seniors. And before the break, we were talking about the top three, obviously confidence fraud, romance scams, particularly on the uptick during the course of the pandemic as a result of everybody just kind of feeling a little bit more lonely as a result of having to stay at home more. And then number two on that, of course, is compromised emails, where you're getting an email that says, please verify your information, take our survey, things like that. Identity theft more than tripled during the course of 2018 versus 2020. So COVID was not kind to cybersecurity and cyber fraud. And then lastly, in terms of the three biggies, tech support, you click on this because you've got a problem with your software, you need to upgrade something, or you need to renew your subscription. Make sure you look when you're hovering around on the internet. Make sure you look for that little lock icon at the very beginning on that address bar, because then that means that it has been verified on the security website portion of as you're searching for that. So 7 others to go. Of course, if it's a top 10 list, there's 7 others. We thought we would just roll through those very quickly here on the program, just so folks can kind of be aware of them and keep an eye on that, of course. So here they are in no particular order. An investment-oriented scam, put your money into a stock, cryptocurrency, or hot IPO that doesn't really exist. Might actually use that one on cryptocurrency as a whole, but that's a digression. We refer you to prior programs for that conversation. Real estate rental, right? Anytime you've got a hot market, real estate market is hot, you see scams associated with that. Want to get in on the ground floor of the next big development. Government impersonations is the next one. Folks calling, claiming that they're with the IRS or Social Security and Medicare. Remember, those people don't just randomly call you out of the blue. It starts with a letter, and from there, then it proceeds. But the IRS is not going to call you out of the blue. And again, those types of scams, particularly prevalent during tax season, but the IRS does not call you out of the blue saying, hey, you need to pay us some money now or else you will get arrested. Yeah, that does not happen. Still America, by the way. That doesn't happen. So next is just the notion of spoofing, when someone pretends to be something else or someone else in an attempt to gain your confidence. Non-delivery, here's one again. So again, these scams sort of follow what the headlines are, and certainly with COVID, a lot of these types of scams have seen a big increase. So when we're thinking about non-delivery of some good or product that you ordered, supply chain already messed up, so you'd be more inclined to be like, yeah, okay, it probably is messed up, so I'll just give them my information to let them verify and know what the details are. Identity theft, right? Taking your social security number, things like that. And then lottery, sweepstakes, inheritance, the prince from Africa who's got, $10 million and he just needs a place to put it for a couple of weeks and he'll give you a cut. Yeah, that doesn't work and that's not for real. But it still traps people. And so you still see that as one of those scams that you've got to be aware of. So those are the 10 biggest online scams, particularly targeting seniors, courtesy of the FBI. So just be aware of those, and certainly something that everybody, no matter whether you're a senior or not, want to be aware of, particularly operating in this world. Speaking of operating in this world, one of the things that you didn't do 20 odd years ago was this thing called blogging. So if you're interested in our latest blog post on our website at Nelson Financial Planning, that just went live a week or so ago, got a variety of topics in there. We thought we would just kind of hit upon one. And if you're interested in hearing more about a wide variety of topics, go to our website at Nelson Financial Planning. There is a tab that says blog. If you click on that, you will see our latest blog post. But one of the things that we talked about in our latest blog post is the notion of how a mutual fund pays out dividends and capital gains. And certainly that is a timely topic given that we're in the middle of tax season and particularly for after-tax counts. Now, obviously, when a dividend or capital gain gets paid on a fund inside of a retirement account, there is nothing that you need to do because everything inside that IRA or that 401k or whatever the case may be is tax deferred. So as that money is getting paid out and reinvested, there's no reason that you've got to worry about that on your tax return. Where you do have to worry about it is if it's an after-tax account, right? Money that you use to start what we like to think of as a regular investment account. Maybe that's a joint account, maybe that's a trust account, maybe that's a payable on death account. Those types of accounts are all done with after-tax money. To the extent there's a dividend or capital gain that's paid out or generated, then yeah, you got to take that and you have to put that on your tax return. The reality is, when you go through a period of time where there's a good performance in the market, then those dividends and capital gains have a tendency to go up and go up over time. So what we're seeing is a significant uptick last year over the prior year and over the prior many years, where those dividends and capital gains were in fact much, much higher than what they have traditionally been. So what does that mean for your tax return? That means that you're probably going to wind up paying a little bit more than what you originally thought. So just be aware of that and how that comes into play. Of course, when a fund pays out a dividend or a capital gain, what happens is that's part of the underlying share price of that fund. Because if you're a fund, companies pay dividends or generate capital gains on a regular basis during the course of the year. So that income, that profit, if you will, winds up accruing itself inside of the share price of that fund. And then maybe it's quarterly. Some funds will certainly pay out dividends on a quarterly basis. For the most part, though, most of those payouts of dividends and capital gains actually occur at the end of the year. So what happens there is that you see that share price of that fund drop for a day as those dividends and capital gains get paid out. And then if they're reinvested, in essence, that keeps the dollar amount the same. So certainly for a day before those dividends and capital gains sort of come back into the fold, if you will, you may think, well, wait a minute, why did I lose so much money? The reality is you didn't. The payout of a dividend or capital gain is a zero sum in terms of the value of that fund if those dividends and capital gains are getting reinvested. So that's just something to be aware of in terms of how funds pay out dividends and capital gains, and just something to be aware of more specifically for this tax season, because they are in fact a higher amount than what they have been in the past. We like to use those dividends and capital gains to help rebalance portfolios, because if you have those dividends and capital gains cross-invest into a different fund, maybe that's a fund that has a piece of a portfolio that you're kind of lacking or you don't have as much in and you want to kind of get some more over into that particular category, then cross-reinvesting those dividends and capital gains over to that new fund gives you an opportunity to kind of rebalance the portfolio as well. So a great way to use that normal activity to rebalance the portfolio, to use those dividends and capital gains. So all of that we talk about in our blog post. If you're interested in learning more, go to our website, Nelson Financial Planning, and look at the blog tab and you will find that. In the meantime, we got to get out of here. Enjoy the rest of the Sunday. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.